It's no secret that real estate is a booming investment sector right now. The market is hotter than ever, and there are many ways to get involved. If you're looking to invest your hard earned money in real estate, why not minimize your income taxes at the same time? Other than being one of the time tested investments, real estate is also a great way to save money and reduce income taxes. Income tax can be avoided, and the good part is it's not illegal. In short, it's just a matter of knowing your options and how to play the system to your advantage. If you're really interested, then you're in the right video. Here you will learn the ways you can do to reduce your income taxes when you invest in real estate. Please consider liking and subscribing, especially if you like this type of content. We always appreciate any kind of support. Note that the ideas and suggestions presented in the video are for informational purposes only. Please consult a certified expert first before making any financial decisions. Welcome to EM3 Financial Freedom Strategies, where you learn how to manage your time and money to achieve financial freedom. If you want to know all the juicy details, then make sure to watch until the very end. Big earning real estate investors who know how to deal with money only pay little income tax. Some investors who earn a lot of money from their real estate investments have to pay a lot of income tax because they don't understand some of the ways there are that they can legally use to reduce income tax. It must be known that it's possible to get positive gains while also having losses that can reduce taxes. Lots of investors do not know how to deal with those aspects, so they somehow end up losing money or gaining returns but incurring a higher tax bill than necessary. Before delving deeper, one should know exactly what depreciation is, especially for new real estate investors. Simply put, it is the amount by which the value of the property has decreased over the years. A property can depreciate in value due to a number of factors, such as wear and tear and constant changes in market conditions. Imagine your cell phone. Once you put it out of the box, the value of that cell phone already depreciated. In about 2 years, the price might even go lower than half the original price. So this means that the money you paid to purchase that phone is actually smaller than the actual value itself. Keep in mind that depreciation is present in all sorts of goods, and real estate is included. The difference between real estate and the cell phone is, of course, the potential to increase the price. If you bought a property years ago, the property could actually appreciate through time as the area around it gets more developed, or if you forcefully increase its value through rehabs. On to the point, how can depreciation in real estate help you reduce your income tax? Depreciation is a tax-deductible cost for real estate investors who own rental properties that generate revenue. As a result, you'll likely have a lower tax burden and less taxable income. Keep in mind, however, that having depreciation means a lower price when selling the property. For instance, just because your property had been with you for decades does not mean that the value of that property in the market is less than half the original price. It must also be noted that depreciation resets every time there's a new owner. The usual period for depreciation is 27.5 years, with the depreciation distributed evenly over the period. Some of the peripherals included in the property, such as landscape, fences, garages, kitchens, and appliances, are also considered as depreciable properties with a period of 5 to 7 years of ownership. The basis for depreciation involves the price of the property, not including the land price. Therefore, if you're thinking of buying lots of land to offset your tax, it won't really help much because the basis includes the building, which are the walls, roofs, windows, and etc. Costs also include maintenance, utilities, landscaping, and the cost of hiring people to manage the property. There are also operating expenses that include upkeep and repair costs. Take note that these expenses vary depending on the property type and location as well. Now you must be wondering, depreciation takes time to take place. How can you use it much sooner? Surely you do not want to wait for like 27 years just to reap the benefits. Well, there is actually a way to accelerate depreciation. With this, it is possible for you to make positive cash flows while showing some kind of loss on your tax return. The straight line depreciation is commonly used by tax experts. It is also the most straightforward method to use when determining a deduction from your income for tax purposes. However, if you use accelerated depreciation instead, then the amount of expense you can report to reduce your tax is immense. In the current fiscal year, the loss may be applied to offset gains from other investments, or it may be held till next year and then applied as a deduction in subsequent tax years up until the deduction is depleted. Another way for you to reduce tax while earning from real estate is to follow the 7-day vacation rule. This rule states that the taxpayer is allowed to deduct expenses incurred during a 7-day vacation stay in a property as long as the use was for personal purposes and not for business or commercial purposes. If you rent out your property for more than 7 consecutive days, then you have to treat it as a commercial rental, which is subject to a higher tax rate. For instance, if you rented your house for 100 days in a year, and the mean tenure of each reservation was 6 days, you would be qualified to deduct losses from your taxes because your rentals were less than the market average of 7 days. Because they generate a steady stream of revenue with little effort, vacation rentals are sometimes seen as passive activities. This is because they have relatively low barriers to entry, such as requiring very little capital to get started, and they typically require little management effort to run successfully. As a result, some of the profit generated by these rentals may be classified as passive income, which is taxed at a lower rate than other types of income. When you stay for less than 7 days, you avoid all of the problems associated with passive loss rules that an active or commercial vacation rental would face. If you want to turn passive losses into active losses, then you need to treat the activity as an active business activity that requires full-time attention from you, which also means more than 7 days of rent. Hopefully, this video helped you learn more about how you can strategically reduce your income tax through real estate legally. Remember that it does not have to be complicated or expensive to achieve long-term financial goals. For every obstacle you face along the way, there are also subsequent fixes you can employ to maximize your advantage. Please like and subscribe to see more of our content. Feel free to share your thoughts and ideas in the comments down below. If you liked our content, then please check out our other videos. Thank you for watching and see you in the next video.